Mark this date, April 16th, 2026, because what happened this morning in Canberra will echo through commodity markets long after the political press has moved on to the next headline, and the people who understand why will be very glad they were paying attention while others were not. There are moments in public life when a government official steps before a microphone and says something that the financial media will dutifully transcribe without genuinely understanding what they have just heard. Today was one of those moments. At the National Press Club in Canberra, Australian Defence Minister Richard Marles delivered what history may well record as the most consequential economic announcement this nation has made in a generation, not because of its political dimensions, which are considerable, but because of its industrial ones, which are staggering, and which the mainstream commentary will take weeks to properly map. We are going to map them now, before the dust has settled, before the interpretive consensus has calcified into something comfortable and incomplete. Here is what actually happened. Minister Marles unveiled Australia's 2026 National Defence Strategy, and embedded within its language and figures is a commitment so large, so sustained, and so materially specific in its requirements that it constitutes, for the silver market, nothing less than a structural demand event of the first order. The headline numbers are striking enough on their own. An additional 14 billion Australian dollars in defence spending over the next 4 years, a total of 53 billion Australian dollars in new defence investment over the next decade. A commitment to raise Australia's defence budget to 3% of GDP by 2033, a threshold the nation has never crossed in peacetime, and which, when you do the arithmetic against a growing economy, produces procurement figures that are not merely large, but categorically transformative. Total government defence investment, including the AUKUS nuclear submarine program, is expected to reach 330 billion Australian dollars through to 2033-34. These are not estimates. They are not aspirational targets penciled into a budget document with escape clauses. They are commitments backed by the full weight of a sovereign government that Marles himself described, in language notable for its historical self-awareness, as the biggest peacetime increase in defence spending Australia has ever seen. But here is what the political reporters are not writing about today, and what requires our careful attention. The substance of what Australia is buying with this money is not merely militarily significant. It is metallurgically specific, and the metal it is most specifically demanding, the metal that appears in virtually every system, platform, and capability that the 2026 National Defence Strategy prioritizes, is silver. Consider the architecture of what Marles announced. The centerpiece of this expansion, the systems receiving the most immediate funding acceleration and the most explicit strategic priority, are autonomous and uncrewed platforms. The Ghost Bat, officially designated the MQ-28A, is an Australian-developed stealth combat drone, a force multiplier for the Royal Australian Air Force, now entering funded production. The Ghost Shark is a large autonomous underwater vehicle being fast-tracked as a strategic deterrent capability in the Indo-Pacific. Beyond these two headline programs, the strategy calls for the expanded deployment of autonomous systems across all three domains: land, sea, and air, along with a comprehensive upgrade of long-range strike capabilities and the accelerated introduction of integrated air and missile defense systems. Each of these represents, in plain industrial terms, a sustained and large-scale demand for the most electrically conductive element on the periodic table. Silver is not an incidental ingredient in modern defense electronics. It is a foundational one. It appears in the radar systems and electronic warfare suites that make autonomous platforms functional. It appears in the high-frequency sensors and precision navigation arrays that allow an unmanned vehicle to operate with the reliability that defense contractors, who do not accept second best, require. It appears in the advanced circuitry of missile guidance systems, in the connectors and contacts of communication networks, in the thermal management systems of high-performance chips that process battlefield data in real time. There is no commercially viable substitute that performs at equivalent levels in the temperature ranges, frequency demands, and reliability thresholds that military applications require. When the defense establishment commits to a decade-long expansion of silver-intensive autonomous systems, it is not making a discretionary choice about which metal to favor. It is acknowledging a physical reality that the periodic table encoded long before any government budget was written. Now consider what this means against the backdrop of the silver market as it actually exists today. The spot price of silver in Australian dollars is currently sitting at approximately $112 per ounce, a figure that already reflects the extraordinary structural pressures that have been building in this market through 6 consecutive years of global supply deficit. The USD spot price crossed back above $80 per ounce today, rising 1.74% in a single session. But here is the detail that tells you more about the state of the physical market than any spot price chart. As of this morning, the Perth Mint, Australia's own government-owned precious metals institution, one of the most respected bullion operations on Earth, is listing silver as simply not available for retail sale. Not sold out with a restock date, not temporarily delayed, not available. In the language of physical commodity markets, those two words carry enormous informational weight. They tell you that the pipeline between mine and retail counter is not flowing freely. They tell you that material is being absorbed at levels upstream by industrial buyers, by institutional hands, by procurement pipelines, before it reaches the point where the ordinary investor can access it. They tell you, if you are fluent in the vocabulary of supply stress, that the paper price and the physical reality have begun to separate in a way that historically resolves in one direction only. This is not a coincidence, it is a sequence. And the sequence began long before this morning's announcement, which means that what Marles revealed at the National Press Club today did not create this situation. It amplified one that was already well underway, and did so with the force of 53 billion Australian dollars and the authority of sovereign commitment. If you have ever wondered what it looks and feels like to watch a commodity market transition from a cyclical story into a structural one, you are watching it happen right now, in real time, with a clarity that history rarely affords to those present at the moment of transition. Most people who will eventually understand the significance of what is occurring in the silver market in April of 2026 will understand it retrospectively, the way one understands the significance of a turning point in hindsight, when the turning is already complete. The purpose of this analysis is to understand it while the turn is still in progress, when the implications are still actionable, when the story has not yet been told to everyone by the headlines that will inevitably come. Let us begin with the global context, because Australia's announcement today does not exist in isolation. It is the most recent and most clearly articulated chapter of a defense spending expansion that has been reshaping industrial demand across the developed world for the past 2 years. NATO members across Europe have been racing toward, and in many cases beyond, the 2% of GDP spending threshold. The United States, with its January 2026 National Defense Strategy explicitly calling on allies to shoulder more of their own security burden, has provided both the policy framework and the strategic incentive for exactly the kind of commitment that Marles made today. Japan has doubled its defense budget. South Korea is accelerating autonomous systems procurement. The Indo-Pacific, as a geographical zone of strategic competition, is being militarized at a pace that carries direct and specific implications for the metals that military technology requires. And the most electrically capable, the most industrially irreplaceable, the most structurally undersupplied of those metals is silver. Here is the supply reality, stated with the directness it deserves. The global silver market has now run a structural deficit for 6 consecutive years. The Silver Institute and Metals Focus have documented that approximately 762 million troy ounces have been drawn from above-ground stocks since 2021, simply to bridge the gap between what mines produce and what the world consumes. Global mine production runs approximately 830 million ounces annually, meaning the world has spent nearly a full year's worth of existing inventory just keeping pace with demand across 6 years of persistent shortfall. And the supply side cannot simply respond to rising prices by producing more. Approximately 70% of the world's silver comes not from primary silver mines, but as a byproduct of copper, zinc, and lead mining, meaning production decisions are made on the economics of those other metals, not on silver's price signal. New primary silver mines, when economically justified, require a decade or more of permitting and development before meaningful production begins. The supply curve is, by structural design, slow. The demand curve, in a world where governments are moving at what Marles himself called wartime speed, is fast. Dangerously, historically fast. This asymmetry, between the slow supply and the accelerating demand, is the fundamental equation of the silver market in 2026. And it is being intensified right now by a development that the Western financial press has underweighted with a consistency that is itself remarkable. China, which controls an estimated 60 to 70% of global silver refining capacity, despite producing only approximately 13% of mined silver, implemented a strategic export licensing regime for refined silver effective January 1st of this year. Under this system, all silver exports require government approval, with only 44 companies authorized to export at all. Beijing has, in effect, classified silver alongside rare earth elements as a strategic national resource, a designation that speaks with extraordinary eloquence about how the world's most powerful industrial economy views the metal's strategic importance in the decades ahead. The practical consequence for markets outside China is that the flow of refined silver to Western exchanges, to COMEX in New York, to the LBMA in London, has been bureaucratically restricted at precisely the moment when Western defense industries are beginning to demand it at accelerating rates. The physical premium data confirms what the structural analysis predicts. Across major Australian bullion dealers today, premium gaps between paper spot price and physical product have widened to ranges that market participants recognize as stress signals. In certain Asian secondary markets, physical silver has traded at premiums of 10 to 13% above published benchmarks. In Japan, at various points this year, retail premiums reached approximately 60% above spot levels, a figure so extreme it barely seems credible until you understand the supply dynamics that produce it. The Perth Mint's not available designation for retail silver today is the Australian expression of a physical tightness that is being felt, at varying intensities, across every major market where people attempt to take possession of actual metal rather than paper representations of it. Now here is the part of the story that demands your full attention, because it involves a market mechanic that most financial commentators either do not understand or choose not to explain clearly. There are, at this moment, two parallel silver markets operating simultaneously, not just in Australia but globally. There is the paper market, futures contracts on COMEX, exchange-traded funds, spot price quotes that scroll across financial terminals and appear on websites. This market currently shows silver at approximately $112 per ounce domestically, around $80 in global terms. And then there is the physical market, the market for silver you can actually hold, take delivery of, store, and use in a manufacturing process or a weapons system. In that market, the real price, the price at which willing sellers will part with physical metal on reasonable timeframes, is measurably higher than the paper price, and the gap is widening. This gap is not an anomaly. It is not a temporary inefficiency that arbitrage will quickly close. It is a structural signal that the paper price has not yet caught up with the physical reality. And in the history of precious and industrial metals markets, when this kind of divergence builds over an extended period and is then met with a large, sustained, government-mandated demand event, exactly the kind that Marles announced this morning, the resolution of that divergence does not happen gradually. It happens in the repricing events that people subsequently describe as sudden and surprising, despite the fact that the structural foundations were entirely visible beforehand to anyone who looked. If you have found this analysis valuable, if you are one of the people who wants to understand the connection between geopolitical announcements and commodity markets before the consensus catches up, then what you do in the next 30 seconds matters. Because the work of tracking these developments, of connecting defense strategy documents to physical market signals, of translating government procurement announcements into commodity supply equations, requires an audience that is genuinely engaged. Subscribe if you have not already. Share this with someone who deserves to understand what is happening in the silver market right now. Because by the time this story is obvious, the optimal moment for understanding it will have passed. There is a phrase in strategic analysis, used by military planners and occasionally borrowed by market observers, that describes the moment when multiple independent forces converge on the same pressure point simultaneously. The phrase is culminating point, and it refers not to a climax, but to the moment at which the accumulated weight of separate developments becomes impossible for a system to absorb without fundamental change. The silver market, as viewed from Australia on April 16, 2026, has the characteristics of a market approaching its culminating point. And the announcement from the National Press Club this morning may, in retrospect, be the event that future analysts identify as the moment when the convergence became undeniable. Let us count the forces that have now converged, because individually each one of them would be significant. Together, they constitute something that belongs in a different category entirely. First, 6 consecutive years of global supply deficit, with 762 million troy ounces drawn from above-ground stocks since 2021. The Silver Institute projects that this structural shortfall will continue through 2026 and beyond, with annual deficits running at tens of millions of ounces in a market where the total annual mine supply is approximately 830 million ounces. The world is not running out of silver in the dramatic overnight sense. It is running down the available inventory that bridges the gap between what mines produce and what the world consumes. and that process, once advanced sufficiently, does not reverse quickly. Second, China's strategic reclassification of silver as a controlled export material, effective January 2026. A nation that dominates global silver refining has erected administrative barriers between its refined metal and the Western markets that have historically depended on that flow. This is not a tariff that can be circumvented through price competition. It is a licensing regime with a fixed number of authorized exporters, designed to prioritize domestic industrial consumption over international supply. For defense industries in Australia, the United States, and European NATO members that are simultaneously expanding their silver-intensive procurement, this supply restriction arrives at the worst possible moment. Third, COMEX registered inventory. The pool of silver legally committed and available for physical delivery has been declining for months, producing coverage ratios between paper contracts outstanding and physical metal available that market analysts describe as mathematically fragile. In January of this year, 33 million ounces were withdrawn from COMEX for delivery in a single week, representing approximately 26% of registered inventory in 7 days. This is not normal market behavior. This is the physical delivery system under stress of a kind that has historically preceded either significant rule changes from the exchange, margin increases, restrictions on delivery demand, or significant price movements, or both. Fourth, global defense spending is accelerating across every major Western alliance partner simultaneously, with Australia's announcement today the latest and one of the largest single commitments in this multi-nation rearming cycle. The Ghost Bat, the Ghost Shark, the long-range strike systems, the integrated air and missile defense networks. Each of these represents not a one-time procurement, but a sustained manufacturing program with a multi-year industrial supply chain that will require silver continuously, predictably, and in volumes that are now backed by 53 billion Australian dollars of committed sovereign capital. Defense procurement does not respond to silver price signals the way a consumer electronics manufacturer might. Defense contractors do not substitute copper when silver becomes expensive. They secure the silver at whatever premium the physical market requires, because the alternative is a weapons system that does not meet specification. Fifth, and perhaps most immediately legible, the Perth Mint, which is not a marginal dealer but the government-owned precious metals institution of the nation that just announced the largest peacetime defense expansion in its history, is today listing silver for retail sale as simply not available. This is the physical market speaking in the clearest language available to it. It is saying that the metal you are looking for has already moved upstream, into industrial pipelines, into defense procurement channels, into the hands of buyers for whom securing supply takes precedence over the premium they must pay to do so. Now here is the question that the careful observer must sit with, because it is genuinely difficult, and honest analysis requires acknowledging that difficulty. Does today's defense announcement, by itself, transform the silver market? No. It is an addition, a large and consequential addition, to pressures that were already building. The structural deficit predates this morning's press conference by 6 years. The COMEX inventory stress predates it by months. China's export restrictions predate it by 3.5 months. What today's announcement does is this. It converts what was a structurally stressed market facing diffuse and somewhat anonymous demand pressure into a market facing a specific, publicly announced, government-mandated, decade-long industrial demand commitment from one of the world's significant sovereign buyers of advanced military technology. It gives the demand side of the silver equation a face, a timeline, a dollar figure, and the credibility of a sovereign guarantee. For the investor or saver watching this unfold, the framework that matters is this. The paper price of silver, $112 per ounce today, approximately $80 in global terms, reflects the market's current incomplete integration of these converging forces. It has come a very long distance from where it was 2 years ago, but the physical market's behavior, the premium expansion, the delivery stress, the Perth Mint's not available designation, suggests that the paper price is still running behind the physical reality. And physical reality in commodity markets is not a permanent hostage of paper pricing. It eventually asserts itself through the only mechanism available to it, price. The most significant moves in silver's modern history have shared a common structure, a prolonged period of structural stress that builds quietly, a convergence of demand forces that the market supply side cannot quickly accommodate, and then a repricing that surprises the consensus because the consensus was watching the paper price rather than the physical behavior. The 1980 event was a speculative episode built on a shallow foundation. The 2010-2011 move was rooted in more genuine industrial demand. The January 2026 surge to an all-time nominal high of $121.67 per ounce was rooted in the deepest and most multidimensional structural story silver has faced in the modern era. The subsequent pullback to current levels of approximately $80 has not resolved the underlying pressures. It has given those pressures more time to build, more inventory to absorb, and now, as of this morning, a new and enormous demand commitment to incorporate. Minister Marles stood at the National Press Club and told Australia and the world that his country faces its most complex and threatening strategic circumstances since the end of the Second World War. He described a global environment in which international norms are eroding, in which nuclear arsenals are growing for the first time in decades, in which the Iran conflict has made the world, in his own words, feel less safe. He then committed 53 billion Australian dollars to building the weapons systems and autonomous platforms that he believes this environment requires. He did not mention silver. He did not need to. The engineers who will build the Ghost Bat understand exactly what it requires. The procurement officers who will sign the manufacturing contracts understand exactly what goes into each component. The supply chain managers who will secure the industrial inputs understand exactly which metal is irreplaceable and exactly how tight the market for that metal currently is. The mainstream financial media will write about this announcement in terms of strategic posture, alliance dynamics, budget allocations, and electoral politics. All of that analysis will be accurate as far as it goes, but it will not go far enough. Because embedded within the most consequential peacetime defense announcement in Australian history is a demand commitment for the most electrically capable, most industrially essential, most structurally undersupplied metal on the market. And that commitment is now official, funded, and accelerating. The question before you now is not whether this story is real. The data is not ambiguous, the announcement is not hypothetical, and the physical market stress is not a rumor. The question is whether you are among the people who understand this while the understanding is still rare, or among the many who will understand it later, when it is no longer rare enough to matter. What do you think? Does today's Canberra announcement change your view of silver's industrial demand story? Or were you already watching this market closely enough that it simply confirms what you already suspected? Drop your honest perspective in the comments below. The most valuable thing that comes out of conversations like this is not any single analysis, but the collective intelligence of people who are paying serious attention. And if you know someone, a friend, a colleague, a family member, who is watching the Australian economy, tracking the precious metals market, or simply trying to understand what is happening to global strategic resource pricing, share this with them today. These are the conversations that need to be happening at kitchen tables and in investment discussions, not just in the research departments of institutions that are already positioned. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.